Hi, I'm Jason Hartman, and since it's the last of the 10 Commandments today, the 10 Commandments of Successful Investing, I figured I'd bring in the dog. This is Coco, and she's not a real estate investor, but she thinks you should stay out of the doghouse when investing. Bad attempt at humor. Okay, anyway, let's talk about the final 10th commandment, right? Now we do have, as I mentioned before, an additional 10 commandments, but these are the original 10. And this one is about taxes. Now a lot of people get really bored when I talk about taxes at our real estate conferences. Their eyes roll back in their head and they think taxes, that's so boring, it's such a boring subject. But what you need to realize is that taxes are the single largest expense in most people's life, right? They are the single largest expense. You know, we'll spend a lot of time and a lot of effort shopping for a new car, getting a good deal, even on a piece of real estate, right? We'll put a lot of effort into that. But we won't put any effort at all into saving on the single largest expense in life, taxes. I think the dog has got to get down. So I'm going to take a break for a minute. We'll be right back. Do you know during your lifetime, you will, just in income taxes, give away anywhere between probably 30 and 55% of your income in just income tax, right? Just income tax. And then add on all the other taxes, sales tax, you know, car registration, that's a tax, right? All these other taxes, things that are taxed before you even before you even buy them, they're taxed many times, right? We're all paying a lot of money in tax. Now, wouldn't it be nice if we could find an investment that is the most tax-favored asset class in America? Guess what that is? Income property, the most tax-favored asset class in America. So, if we could invest in this and cut our tax bill or even eliminate our tax bill. I mean, wealthy real estate investors pay little or no tax sometimes. Why? Because income property has this magic tax benefit. It's called depreciation. Now, depreciation has some very unique characteristics because it is what I call a phantom write-off or a non-cash write-off. Look it, if you want to save on taxes, the thing you have to do most of the time is you have to either, say for example, you own your own business, right? Or you're an independent contractor. You can spend more money on your business and you can deduct that money you spent. You could spend more money on advertising, hire more people, buy some equipment, right? All tax deductible stuff, right? Or you could donate money to charity and you could take a tax deduction for that donation. Those are the two basic ways people get tax benefits. But with income property, you can buy it and you can get a tax deduction even when you're making a profit. And you don't have to write a check for the tax deduction because it's a phantom write-off. It's a non-cash write-off. So here's the reason income property is so awesome. You know, most people when they buy a property, they just think they're buying one thing. I say you're buying two things. One thing you're buying, there are two components, okay? One thing you're buying is the land, okay? So here's a plot of land, right? Land, right? And the land has a certain value, doesn't it? Now, on top of the land, you know, you might have a house or an apartment building. That's known as an improvement, right? The house or the apartment or office building or whatever it is, sitting on top of the land is the improvement, and then you have the land. You've got to subdivide these values. Now, one of the things I talk about in something I created and discovered after 19 years in the real estate business is something called the Hartman Risk Evaluator. We'll talk about that on a future video. It's a way that you can basically eliminate or at least dramatically reduce your risk when buying an income property because you consider the two components and the value of each component in what I call the LTI ratio. LTI, okay? This is my term I made up because you may have heard of in financing the LTV ratio, the loan to value ratio. Well, this is the land to improvement ratio, the land to improvement ratio. So what the IRS, our taxing agency, allows us to do is depreciate losses in businesses, right? And whenever you own a rental property, you own a business. And you file the results of this business on your tax return on something known as Schedule E. Schedule E for Edward, right? And on Schedule E, you get to depreciate the property. Now the IRS says, look, we understand that the land is durable, it will always be there, the land doesn't go away, right? But someday the house will fall to the ground, or the apartment building will just become so decrepit, it will have no economic value eventually. And for some odd reason, probably the result of lobbyists, okay, they have decided that a house lasts 27.5 years. Okay, 27 and a half years. Now, how long does a house last? Well, a lot longer than that. We all know that. The best answer I got at one of my live conferences was, how long does a house last? It depends on the tenant. Good answer, right? But everybody would probably agree that a house will typically last, before it needs any major remodel of any kind, about 60 years, more than double what the IRS says. In fact, I remember years ago, my girlfriend at the time and I, we were in Paris. And we stayed at the oldest hotel in Paris. And that hotel was like 900 and something years old. It wasn't very nice. It was a novelty. But think about it. 900 years later, that hotel is still sitting there producing cash and income for its owner. Well, it's not the same owner, obviously, because no one lives that long. But the IRS says 27.5 years is the depreciation schedule. So here's how that works. Say in this example, this is a $100,000 property. You pay $100,000 for both components, land and improvement. That's for both of them. But what if you had to subdivide them and establish a value for each component? Well, there's three ways you can know the value of each component. Number one is you can look at the tax collector or tax assessor in the given county and see what value they establish on each thing. Number two, you could have an appraisal, and the appraiser will establish a value on the land and the improvement. They will subdivide them. Number three, you could ask your insurance agent, because your insurance agent doesn't insure the land. They only insure the improvement sitting on the land. Why? Well, the improvement could burn down, but the land will still be there and have value after the fire, right? So they only insure this part, not the whole thing, right? So those are three ways that you can try and determine the value of each component. But for our example, and I hope you have a calculator handy because, well, I don't, but maybe I'll get one for you. So let's say that the land in this example is worth $20,000, right? Well, we know by deduction we paid $100,000 for the whole thing, so the improvement must be worth $80,000, right? $80,000 for the improvement. So now what we do is we take this improvement, the $80,000 component, and we simply depreciate it. So let's get our handy calculator out here and take how much? We're going to take $80,000, right? There's 80,000. And we are going to divide by how much? 27.5 years. So we know when we take $80,000 and divide by 27.5 years, the depreciation schedule, that we get $29.09 per year. $29.09, almost $3,000 per year in depreciation losses. Depreciation losses. Now, understand a couple things. I need to make my disclaimer. I am not a CPA. I'm not an accountant. So check anything I say with your tax professional, okay? I'm also not a lawyer, so when it comes to legal stuff, don't ask me that either. Okay, so 2909 is the allowable depreciation if you qualify for it. Now, if you're in a higher income bracket, it does phase out, okay? But that depreciation is still what they call in the property and could potentially be used later, okay? So that's a complex subject. I interview a lot of CPAs on my podcast, and we talk about this stuff in greater detail. I'm just giving you the concept here. But here's the key. This $2,909 per year in deduction, to get it, you didn't have to write a check. You didn't have to donate money to charity. You didn't have to hire someone to repair the house or spend more money advertising the house for lease or anything like that. You got the deduction through the magic of depreciation, this phantom non-cash write-off, okay? Why is that so significant? Because during the same time that you get this deduction, the property could have positive cash flow, it could be appreciating in value, and everything could be going great. But the IRS on paper still considers this part a loss. It's a tax loss. This is a beautiful thing, because if you own enough properties, you could potentially zero out your income or get close to it and pay very little or no tax. Now, again, like I said, this phases out after a while, but there is one magical way that you can take this deduction still potentially, and that is if you become what's known as a real estate professional. It's a long discussion. I've interviewed CPAs on my podcast talking about this in depth, and I encourage you to listen to those. Not everybody can qualify. Again, long discussion, and it does not have anything specifically to do with being in the real estate business, selling real estate, having a real estate license. It's being a professional investor. That's what it's about. It's a classification that the IRS allows you to potentially take unlimited depreciation deductions, okay? Income property is the most historically proven asset class in the entire world, and it's the most tax-favored asset class in America. There is simply nothing better. What do you think? Go to jasonhartman.com/ask with your questions or comments, or leave a comment below and be sure to subscribe so you don't miss any of our upcoming episodes where we will talk about the risk evaluator, the LTI ratio. We'll go more into this. We got a lot of stuff to talk about. See you on the next episode, and until then, happy investing.